Hello everyone, this is Rob McDougall from Zhang Financial here with your weekly economic update. Today is Tuesday, January 20th, 2026. So last week, economic activity that was released, very favorable. In particular, inflation metrics, a couple of other items. But generally speaking, it was positive for inflation. So last Tuesday, CPI, core CPI came out. Now CPI, exactly as expected, up 2.7% year over year. But core CPI, excluding food and energy, actually up a little less than expected. Expectation was 2.7, came in at 2.6. So that was good news. Then on Wednesday, we had PPI, core PPI, retail sales, ex-auto, across the board, pretty favorable. So PPI itself, the headline number, month over month, was up 0.2% as expected. But core PPI was actually flat for the month. So expectation was a positive 0.2, came in flat. Then retail sales were expected to be up 0.4, as were retail sales ex-auto. Both metrics beat. Retail sales month over month over positive 0.6%, and ex-auto positive 0.5%. Then lastly, in terms of good economic news last week, initial jobless claims. We've had a couple of weekly data points that have been outliers, that have been much stronger than expected. Got another one last week. So on Thursday, initial jobless claims was expected to come in at 215,000, came in under 200,000. That's the second time, I believe, in the last 3 weeks, but it came in at 198,000. So all favorable news. Also last week, the Atlanta Federal Reserve adjusted, as they always do, their GDP estimate, for the fourth quarter. Their estimate the week before was 5.1, super high. Actually moved that up. 5.3% is now their expectation for fourth quarter GDP growth in the U.S. So at the same time, inflation expectations actually has crept up a little bit. Maybe a little last week, probably didn't even notice it. But last week finished at 2.33%. Again, that is the expectation built into the bond market for inflation over the next 10 years. Just 2 weeks ago, it was about 2.25. So not a huge increase, but at the margin, inflation expectations rising, likely because of the expectation that the GDP growth has been so strong in the U.S. Fed fund future market in terms of what the Fed might do. Now, next week is a Fed meeting. They'll start it on next Tuesday, next Wednesday. They'll give the rate decision. Almost no chance they'll be cutting, particularly with the strong GDP growth numbers that we've seen. So there's a 5% probability built into the futures market that they will do one cut. So probably not happening. End of the year, expectations have come back a little bit. So the odds of only one additional rate cut, only 11%. But now a 60% probability of 2 cuts and only 28% of 3 or more cuts. Just 2 weeks ago, there was over 40%, now 28%. So markets last week, in the face of that good economic news, U.S. equities actually down. S&P 500 down about 0.5%. But an interesting note on that, the S&P 500, we always show the equal weighted S&P 500 versus the S&P 500, and for most of the time, the S&P 500 beats equal weighted. Equal weighted just takes all 500, so 20 basis point on average for each of the stocks. That outperformed last week. That was actually up 0.5%. S&P down 0.5%. So simply tells us that the marketing indeed is broadening out. We've talked so much about the Magnificent Seven and their all-time concentration, top 10 stocks at approaching 40% all-time high levels. So it is good, always good to see market breadth widen out. Also last week in the U.S., again with the S&P 500 down, small cap up very strongly, up 1.5% last week, measured by the Russell 2000 index. So international stocks last week, again, S&P down 0.5%, but developed markets ex-US of about 40 basis points. In emerging markets, very strong week, up 1.4% last week. In terms of fixed income in the U.S., the yield curve changed a little bit last week. The 2-year in particular was up 11 basis points. The 10-year was up 3 basis points, so that led a loss on the Bloomberg U.S. Aggregate Bond Index of 8 basis points last week. So let's take a look at the economic news that will hit this week. Now, we've talked many times over the last month or so about the fact that a lot of the economic data that we have is somehow impacted by the government shutdown. This may be the last week of it. I'm not entirely sure, but most of the metrics that we'll be seeing this week will be reported with both the October and the November numbers. So we're just going to focus on the expectation for November numbers. Therefore, if you're looking at the screen, the prior will be filled in with not available. So we will get a GDP growth, the revised third quarter GDP. The initial was 4.3. That's a consensus expectation. The initial jobless claims, again, last week, super strong, only 198,000. So the expectation this week, a little above that, 212,000. But the big items this week, core PCE headline number, personal income, personal spending. Again, all of those will be released on Thursday, and they'll give you both the October and the November numbers. In terms of the November numbers for the PCE, that is expected to be up 0.2% month over month, or positive 2.8% year over year. For core PCE, that's expected to be up also 0.2% month over month, and up 2.7% year over year. Personal income is expected to be up 0.4% month over month for the month of November, and personal spending up a strong 0.5%. Lastly, we will get the Michigan Consumer Sentiment Final. No expectation of movement. The preliminary was already issued for January at 54. That's a consensus for the revised reading. So that's it for the weekly economic update. We thank you very much for attending and hope to see you next week. Thank you.